In this video, we're going to be going over Chapter 12, looking at stocks, which is something that a lot of folks really don't understand much about. Now, what common stock is, you purchase stock, you are actually now an owner in the company. You buy shares and you're giving them money so that they can fund ongoing operations and things like that. As it says here, raising money, paying ongoing business expenses, things like that. But you're an owner in the company, and because of that, you have various rights. You can vote on who it is or who's on the board of directors. You can vote on some of the proposals that people bring forward. Because you're one of the owners, you have a say in how the company is actually being run. The most common form of stock ownership is common stock. Now, this is where they're going to be paying dividends. Dividends are where they are, the board of directors decides, okay, we're going to distribute some of the profits to our owners because they deserve it. They're owners. And so they will declare a dividend. So you're getting a portion of the profits back. Now, there's several facts. Think about investing in stocks. First of all, you can make more money in the stock market than you can with bonds or anything else. You can also lose more money in the stock market than with bonds or anything else. Anytime you're buying stocks and becoming an owner in the company, there is a risk that goes along with it. Common stock's most basic form, okay? Now, dividends are declared by the board of directors, but they do not have to pay them. There are going to be times when companies say, you know what, we don't have much in the way of profits. We're not going to declare a dividend at this point in time. You do have the opportunity to vote on the board of directors and various proposals that are being brought up by various people, owners, other board members, things like that. You may not be attending the annual meeting where you're making the voting, doing the voting. You will receive what's called a proxy, which is where you are deciding how to vote on the various proposals that are being put in front of the board of directors during those annual meetings. Now, how you make money on stocks is from two ways. One, income from the dividends. About once a quarter, most companies will declare a dividend as far as distributing some of the profits, as long as there were profits there. You're also hoping that the value of the stock goes up. In other words, the company is doing well, more people want it, consequently the price of the stock goes up. So you will have a price appreciation whenever you decide to sell. So let's say that you buy a stock at $50 and the stock goes up to $100 a share. You have now made $50. That is called a capital gain. And you'll have to pay taxes on that capital gain. Now, capital gain taxes are much lower than income taxes. The thing is, the government wants its piece. Whenever the board of directors decides there's going to be a dividend, there's several things to think about. There's the declaration date. In other words, the board of directors get together and they say, okay, on this date, we're going to declare a dividend on this date. So it might be like January 10, and they're going to pay a dividend on January 30. The record date is when you have to have that stock owned and it has to be registered with the firm in order to receive the dividend. The ex-dividend date is the second business day before that record date, where the stock is going to start trading without the dividend. It will not pay the dividend. You have to have the stock owned by the record date. On the 2 days before that record date, it's called the ex-dividend date. That's when it starts trading without the dividend. And the reason is because there may be a couple of days in there for the trade to settle. The payment date is when the dividend is actually paid to the owners. Now, you might hear about stock splits. A stock split is done where the company will say, okay, we have 1,000 shares of outstanding stock. What we're going to do is we're going to make that 1,000 shares now 2,000 shares, which means if the stock was trading at $50 a share before, they make the split, the stock is now trading at $25 a share. Because there's more shares out there does not mean that you now have more money. It just means that you now have a stock that each share is worth half of what it was before. Now, there's no guarantees that the stock's price will go up after the split. You're hoping it does, but there's no guarantee that it will. Then you have what's called preferred stock. Now, the others were common stock. This is preferred stock. What preferred stock is kind of a middle investment between the common stock, which has more risk, and bonds, which are loans, which are paid first if the company goes belly up. If a company declares that they're going into receivership, okay, what happens is the bondholders, the ones who hold the loans, will be paid first. Then, if there's any money left over, preferred stockholders will be paid. Then, if there's anything left after that, then the common stock holders will be paid. Dividends don't have to be paid, but normally they are with the preferred stock. And dividends will be paid to the preferred stockholders before any kind of common stockholders. Whenever you're thinking about buying stock, you have to do your research. You have to understand what it is that you're actually purchasing. Does it meet your investment goals? Things like that. Because you can buy some really good stocks, or you can buy what's called penny stocks, which is a stock that has a real good probability where the company's going to go belly up. Now, these are the types of classifications of stocks. You have blue chips, all right? Those are large, stable companies, all right? Whenever anybody thinks about some of the big companies like Walmart or GM or something like that, that's a blue chip stock. Cyclical is a stock that follows the business cycle. So if the business cycle is on an upward trend, that stock will go up with the economy. It'll get rising in value. When the economy goes down, it'll go down in value. A defensive stock is one that remains stable throughout declines in the economy. So, for example, you might be talking about electric companies or something along those lines. A growth stock is one that has a lot of potential as far as increasing in value. When Amazon first went public, it was trading at a particular price, but there was a lot of folks who thought that that would really do well, and it was considered a growth stock. Same thing with Facebook. An income stock is one that will declare dividends quite often. The thing is, the dividends are higher as far as a percentage is concerned than some of the other stocks. Then you hear about caps, okay? Large cap, mid cap, small cap, and micro cap. Cap is short for capitalization. Capitalization. In other words, it's kind of the net worth or the value of that organization. A large cap is in excess of $10 billion. It's a big company and it has a lot of net worth. Mid cap, between $2 and $10 billion. Small cap, between $300 million and $2 billion. And then micro cap, $50 to $300 million. Then you have penny stocks. Now, penny stocks doesn't mean that they trade for pennies, okay? What it means is it's just a few dollars, and there's a real possibility that you'll lose your money because the company may very well go belly up. You can get all kinds of information from the internet. That's where people get a majority of their information as far as stock is concerned. And I'll show you that in a second video. Newspaper coverage doesn't really handle much anymore. The Wall Street Journal still does as far as some of the information on stocks. Do it with get your information from the internet. It's updated by the minute, okay, as you go, and I'll show you that in the second video. One of the things you may hear about is what's called a prospectus. A prospectus is all the information about that stock and about that company that the federal government says these are what owners need to understand and know. It's not an annual report. What it is more of a here's the board of directors, here's what that stock is really all about. Now, this is an example of what I'm going to show you a little bit later on as far as how to find information on stock prices. It's actually in yahoo.finance. And you can see that what it's showing is what's the current price. And it's changing from minute to minute. What's the current price? Has it gone up or down? What did it close at the day before? What did it open at today? What's the range as far as the day is concerned? Over the past week, what has been the range? So in other words, the low over the past year has been $56 a share. The high over the past year has been $80 a share. Now again, this is old, okay, as far as the prices and the information is concerned. The volume is the number of shares that have traded for the day. So there's been almost 5 million shares on this day that's been traded so far. And that continues to change throughout the day. Market cap, 56 billion. So that's big. That's a large cap company. Then you have what's called price to earnings, the price to earnings ratio. In this case, it's 1413. What that means is, what you're doing is you're taking the price that's currently there and dividing that by the earnings per share. And that gives you that price earnings ratio. The earnings per share, okay, it's 534. The dividend yield is about 2.4%. So in other words, the dividend of $1.76 for the year is yielding about 2.5% as far as returns to the stockholders. You'll see also that there's a chart that shows, okay, so what's the price been doing for the day. You can also see it for a year, for a week, for multiple years, things like that. Now, corporate earnings is one of the primary factors that's going to determine the price of the stock. And the reason is because as earnings grow, the value of the organization grows also. Consequently, the stock price will go up. Also, you want to look at earnings per share. In other words, what you do is you take the earnings that they've had, the total net profit that they have, and divide that by the number of shares that are outstanding. As earnings per share increases, that's telling you that it's a healthy company. Price earnings ratio, when you see a PE greater than 20, that's saying that investors are saying, hey, this company is going to grow, all right? This company is doing well. If you see something less than 20, that's saying, you know what? I think they're going to be losing some money. I don't think they're going to be doing that well over the next year or so. And what the things you want to do is not just look at the PE ratio for any company, that you have to look at firms within the same industry, because the earnings per share for the various industries are going to be relatively the same. Because there's going to be some industries that have high returns. So for example, you start talking about companies like Apple, okay, that are into phones and things like that. They're going to have a much higher return. Pharmaceuticals, they're going to have a much higher return than, say, retail, like a Walmart or something like that. So you have to compare these ratios and things to companies that are in that same industry. Dividend yield is how much, what's the percentage yield that you're getting from that dividend for the year. Now you'll hear about other things, okay? So in other words, beta, all right? Beta is basically looking at the volatility for that stock. Book value per share, in other words, it's the net worth, remember assets minus liabilities, net worth divided by the number of shares. The price that you see that's coming up, that people are willing, or it's what the price that people are willing to pay for that stock. They're looking at the dividends, they're looking at the possible future for that company, and they're saying, okay, I'm willing to pay X amount per share for this. Now you may hear about the stock market bubble. There have been multiple times where the stock market has created kind of a bubble. In other words, the stocks are trading higher than what they really should be. Eventually that bubble bursts. You'll hear about primary markets. Now a primary market is where you're purchasing these securities from the investment bank that's handling it. If a company is going to go out and they're going to do what's called an IPO, an initial product offering, what that means is they're going to sell a bunch of stock to the general public. They have one of the big money banks that will handle that for them. What the money bank does is they will take care of all the paperwork, they'll take care of all of the movement of the money, things like that. The secondary market is where securities and stocks that have already been sold are sold back and forth between individuals. So for example, the New York Stock Exchange. The New York Stock Exchange and any of the other securities exchanges like NASDAQ and things like that are secondary markets. And so you hear about what's happening with the New York Stock Exchange. You hear about what's happening with the NASDAQ. That's actually what's looking at the various stocks and the prices and how many shares are actually being sold. The New York Stock Exchange actually started, it's on Wall Street, actually started back in the 1700s, where people were actually on a corner and they were trading stocks back and forth for some of these companies that were doing investigations and getting on ships and going to other countries and things like that. That's where it actually started, and it's been on Wall Street ever since. Now the counter market is the NASDAQ, where these are dealers who buy and sell the stocks. They're not listed on like the big exchanges and things. The people who are buying and selling these things are typically stockbrokers, all right, or an account executive. So, for example, I have my retirement with Edward Jones, and the guy who does that is a broker, and he can buy and sell some of these securities whenever it's necessary. Now, churning is illegal. Churning is where somebody will, one of these brokers will buy and sell on somebody's exchange, on somebody's account, and all they're doing is racking up the fees that go along with that, all the commissions and things. That is illegal, because the people who have these accounts, who are responsible for them, have a fiduciary responsibility to work in that account holder's best interest. Now, do you want to use full service or discount brokerage firm? I use a full service firm, and the reason for that is because I don't want to take the time to research stocks, to find out who it is that I should be investing in, things like that. I don't want to take the time on that. I have other better things to do. Some of the questions to ask on determining whether you should use a discount or a full service brokerage. Can you do it on your own? Do you have access to the internet? Do you have access to the information that's necessary? That's the main thing. What's the typical commission? In other words, if you're buying and selling through someone, you're not a broker, but you're having to go through a broker. Are you willing to pay the commission that goes along with that? Are they charging any kind of fees for statements and things like this? Some of the things that you'll hear about are the various transactions. A market order is where, okay, I want to buy 100 shares of whatever, all right? And so my broker, my account exec will put in the order for that. A limit order is basically saying I'm going to buy or sell something at a specific price. So in other words, I might say, okay, whenever the stock, right now the stock is trading for $100. If it goes up to 120, go ahead and sell. Or right now the stock is going for $100, if it drops to like $80, buy some more. So those are some things to think about as far as some of the stock transactions that are going on. Now, whenever you are buying and selling stocks, you're going to have to pay commissions. Depends on who it is you're dealing with. Some brokerages will charge higher commissions than some of the others. When you start thinking about buying and selling stocks, you have to think about it for the long term. All right? The stock market, on average, has grown over the years 10%. Now, you're looking at maybe 100 years worth of data there. 10% per year. The thing is, there have been years when it's gone up, 20%. And there have been years when it has gone down 20%. Right now, with the coronavirus thing going on, it's down quite a bit. So the buy and hold technique is where you are actually holding on to it for a number of years. All right? And what you're doing is you're hoping that the stock increases in price and value, and you're getting income off of the dividends. Dollar cost average is where, say, over time you buy multiple shares of the same stock, but it's going to be at different prices. So what you do is you take all of those, average it up, and that'll give you what your average price is for that. Now, dividend reinvestment. This is where you have your stock and it's registered someplace and they pay dividends. You don't take the cash. What you do is you just say take the dividend and buy more stock with it. I do that with my account. In other words, I have primarily mutual funds. They will, the stocks in there that are held by the mutual funds will pay dividends. What I have them do is take those dividends and reinvest it in that fund. Now you may hear about buying on margin and selling short. Buying on margin is where you are basically, let's say that you want to buy $10,000 worth of a stock, but you only have $5,000. What you do is you borrow $5,000 from the broker and buy the $10,000 worth of the stock. And let's say that the stock is $100 per share. You're hoping that it goes up to 120. When it goes up to 120, you sell enough shares to pay back the broker. You've made money on that. Selling short is when you're expecting the stock to drop in price. So let's say that you have 1,000 shares of a stock. And what you do is you will borrow some shares from your broker and you sell 2,000 shares. You take that money. The stock drops in price. And what you do then is you buy enough shares to pay back at that lower price to pay back the broker. You've made some money. Another thing to think about, and you'll hear about, is what's called options. An option gives you the opportunity, the right, but not the obligation, to buy stock at a particular price during a particular time. So for example, you might be given an option to buy 1,000 shares in 2 years at a particular price. And it might be, say, $50. Well, what you're hoping is after 2 years, the price actually goes up to maybe $75 or $100. You are going to buy it at $50 because that's what the contract, that's what the option says. And then you can turn around and sell it for the current price, which is maybe $75 or $100 a share. You've made money. That's one of the things that a lot of executives receive in their compensation. They get stock or they get a lot of options. The whole idea behind it is you're hoping you have these options. You hope to purchase at a certain price. You hope that it goes up. You can buy it at that lower price and then sell it at the higher price. These are some of the key points from the chapter. Give me a shout if you have any questions.